Hello and welcome to SKANS ECampus. SKANS ECampus is a gold-approved learning partner of ACCA. On this channel, we bring you demo videos of different courses available at SKANS ECampus. So don't forget to subscribe to our channel to get notifications of additional videos and hit the like button.
Hello guys, and today in this lecture we will be talking about weighted average cost of capital, which is also called the WACC. Now what is the WACC? The WACC is basically the rate that a company is expected to pay on average to all its providers of capital to finance its assets. So to finance your assets, or in our case to finance our project, we basically have three sources of finance. Number one, through equity. So we ask the shareholders to give us money so that we can start the project. And in return, we will give them ownership of the company. Or we could have debt. We go to the bank and ask for a loan at a specified rate that the loan may be prescribed by the bank. Or we could ask for issuing preference shares, which are fixed shares where you do not get the ownership, but you get a preference before the ordinary shares, which is equity, and you have a fixed dividend that you will receive each period. Now, whenever you are to finance a project, your finance director or your CEO will decide what is the percentage that we have to keep. For example, to finance my project of, let's say, to 200 million, I would, let's say, take 40% from equity, 30% from debt, and the remaining, which is 30% again, from preference shares. So if I'm financing my project through this specified method, then how much is my cost of capital? And cost of capital is calculated using the... Now let's do an example to make it more clarified. So we have a project for 200 million, and we know that 30% of that project is financed through equity, which are ordinary shareholders, and we know 40% is financed through debt, and we know 30% is financed through preference shares. So if I look at it, these I will refer to them as my weights. Why will I call them my weights? Because they are telling me how much of that portion of financing is done by equity. So my weight of equity is 0.3, which tells me that 30% of the financing is done by equity. My weight of debt is 0.4, because I know 40% of my debt is paid, 40% of my finances are paid by debt. And the weight of preference shares is 0.3, which tells me that 30% of the financing is done by preference shares. Now let's say that the equity holders demand a return of 10% for their investment, and the debt holder, the bank, demands a return of 12%, and the preference shareholders demand, let's suppose, a return of 8%. So how would a WACC would be calculated? So for a WACC, the formula is weights of equity multiplied by cost of equity, which in our case is 10%, plus weight of debt multiplied by cost of debt into 1 minus t. Why we have done 1 minus t? Because the interest rate is tax deductible. As a result, it has an added advantage which lowers our cost of capital. Plus, we have weight of preference shares into cost of preference shares, and I'm assuming that preference shares currently have no tax advantage. If they have a tax advantage, then we will also multiply it with 1 minus t. So now the next step is you write what is the weight of equity, that is 0.3, what is the cost of equity, that is 10%, what is the weight of debt, that is 40.4, what is the cost of debt, that is 12%, multiplied by 1 minus t. Let's say the tax rate is 20% for simplicity. So I write over here 20% plus what is the weight of preference shares, that is 0.3, and you multiply with the cost of preference shares, which is 8%. Now if I add them up, the value comes out to be 9.24%. So what does this mean? This shows us that of all our projects, discounting the cost of capital that we use to discount all our present values should be done at 9.84. So remember, the purpose of calculating WACC is to find the discount rate to be used to find our present values of cash flow. So therefore, it is very important that we understand how to calculate WACC. Now, the biggest issue that you will have is finding the cost of equity in an ACCA paper, because the cost of debt and the cost of preference shares will normally be given. Now, there are two methods to calculate the cost of equity. We have the dividend valuation method, in which we have two types, the constant dividends and the constant growth in dividends. Plus, we have an capital asset pricing model that we will discuss in the next video. So let's move to the dividend valuation method first. What is the dividend valuation method? It basically refers to a theory which states that the value of a company is basically the present value of all future dividends. And similarly, it says the value of any share is also the present value of all future dividends given by the company. Thus, the market value of a company can be found out if we know the present value of all the future dividends given by that company. So let's take an example. For example, a company is expected to pay $100 for each year for the rest of its life, and it's going to go till infinity. So if I take the present value of all these dividends, it will help me out to find the market value of that share. So let's say I know that this firm is going to receive dividends for $100 each till infinity, keep on going till infinity, and I know my required rate of that company is, let's say, of the required rate by the equity holders is, let's say, 10%. Then if I say 100 over 10%, which you remember is the present value of all cash flows that go till infinity and they are constantly equal, will come out to be what? 1000. So according to dividend valuation method, 1000 should be the value of the share. Now we use the same method, but rather than making market value the subject, we are now making the interest rate or the rate of return of equity the subject, and we write over here R is equal to D over M. Now remember, what is this D? This D is in the first year. So if I know the market value of any share, let's say the share of Coca-Cola is currently trading at $15, and I know that Coca-Cola is going to pay a dividend of $2 per share each period till infinity, then I can calculate the required rate of return by simply putting the dividend, which will be $2, over the market value, which will be 15, and I can find the value to be 0.133, and that means 13.3% will be the required rate of equity that we will use in our WACC. Now this is one method to do the calculations. The other method is that what if the dividends are growing each year? So I know that the stock of Coca-Cola is currently traded at $50, and I know the initial dividend paid, which is in D0, was $2, and I know that the dividend is expected to grow each year by 1%. Remember, these are all assumptions that I'm making. So if I know this, and from dividend valuation method, I know that present value of all future cash flows is calculated to be equal to the market value. Now, in this scenario, in year 1, the dividend will be 2 into 1.01 because it's growing at 1%. In year 2, it will be 2 into 1.01 raised to power square. In year 3, it will be 2 into 1.01 raised to power cube. And the dividend will keep on increasing by 1%. So if you remember, we did a cash flow lecture on when the cash flows are increasing at a constant rate, and we know how to calculate the value of such cash flows, which was value of those cash flows is equal to D naught, which is the initial dividend, multiplied by 1 plus G over the discounting rate, which in our case will be KE, the required return for equity minus growth. Now using the same formula, now we will make KE the subject. So if I make KE the subject, it becomes something like this, where D naught into 1 plus G over market value plus G. And using this, now how I can calculate the value of the cost of equity is, I know that cost of equity will be 2 into 1.01, which is D1, over market value, which is 50, plus the growth rate, which is 1%. Now if we calculate the value, it will be 5.04%. Clear? And in some of the questions, they might ask you to also find out the growth rates. So the growth rates for your dividends may also have to be taken out, the growth rate. Now how can we find the growth rate? One example is using historical analysis. So they might give you in your question that the dividends per share is in 2007 0.24, in 2008 it's 0.27, in 2009 is 0.29, and in 2010 is 0.32. So what do you expect the growth rate will be in 2011? So we will assume that the change in each period has been coming at an equal rate, at an equal compounding rate. So the method is that you assume that you invested $0.24, and after 3 years time, which was in 2007, after 3 years time in 2010, it became 0.32. So if I write 0.24 and it's a compounding effect, 1 plus G raised to the power cube, remember if you put it in a bank and you earn interest for 3 years, is equal to 0.32. So similarly, we use this ideology to understand the growth rate that may come out of the dividends, assuming that the growth in each year has been an equally compounded effect. So I use this formula, and then further on I can write G is equal to 0.3 over 0.24 raised to the power 1 over 3 minus 1. So I could formalize this example by writing that what was 0.32, that was the latest dividend, and what was 0.24, that was the dividend n years ago. For example, in our case 3 years ago, divided by 1 over n. So I wrote over here 1 over n minus the whole formula is minus 1. Now if I use this formula and do the calculations, my value will come out to be 10%. This is one method of calculating the growth rate. The other method that we can use is another method called the Gordon growth method as well, is that the growth rate is basically a product of cost of equity and the retention ratio. So what is the retention ratio? The proportion of earnings reinvested for growth. So if you have earned $10 profit and you gave $3 as dividend, then $7 is what? That is your retention. So I can write the retention ratio to be 7 over 10, which is 70%. Or alternatively, I could write 1 minus dividend payout ratio. What was my dividend payout ratio? It was $3 out of the profit of 10. So 3 over 10 is 30%. So I get 70% again. So if I know this retention ratio, I just multiply with the cost of equity to get my growth rate. So now we have completed our lecture and we have discussed about how to calculate WACC and how to calculate the cost of equity using the dividend valuation method. My recommendation would be to do some practice of these dividend valuation method questions. One way is that whatever questions I just did in this lecture, just change the values and find out new answers to see how you are able to process the calculations. And if you have still confusion after that, you are welcome to email.
If you like this video, visit our website www.skansecampus.com to purchase the complete course at affordable prices. Register today at no cost and access our free 10-day trial.